Welcome, I'm Catherine Magaña here with Rachel Ivanovich, Steve Wolff, and Greg Carroll, where we're here to provide you insights about the markets, financial planning, and tax planning. And here we are, we're still talking about tariffs, taxes, and Fed cuts. It looks like tariffs, as of last Friday, the appeals court ruled against Trump's tariffs. And now we're seeing that Trump is asking the Supreme Court to save the emergency tariff. So once again, we're talking about tariffs, and there's always something that's going on in the world. And then we have taxes. So I think we have a couple deadlines coming up.
Yeah, we do. Third quarter estimates are coming up September 15th. And what that means is if you have investment income or you have a business, you will want to talk with us to make sure that you're paying in enough money to satisfy the government, but don't give them a free loan. So you just want to make sure that...
It's always interesting because it's September. It just seems like it comes really quick for some reason.
It seems odd because the third quarter isn't actually over yet. And so, but that third quarter estimate is due. And the other thing that's due is if you have a business, we have corporate taxes are due, S-Corp are due the 15th of September because C-Corps are due in October. And why they have a different deadline? Actually, I think it's because you have to get the K-1s out to any partners from those S-Corps or LLCs in time for the October 15th deadline.
And so usually around this time, then we start seeing those that are funding SEP IRA contributions or solo 401k profit sharing. Is
correct. So if you have a small business and you still haven't done your profit sharing, you'd still have until September 15th to make that contribution for 2024. So SEP IRAs, profit share, you still have time to make that contribution.
And now the probability for a Fed cut has been changing. It's now still high. We're at about 97% chance of a rate cut in September. And here we are. We're already in September. We just had Labor Day, and we're having a short week this week, but it seems like there's always a lot of things going on in the world.
You know, I think there's more volatility in the prediction of when the rate cuts are going to happen, if they're going to happen, than there is in the stock market.
Well, let's just see what happens the day before. Because there's always something in the world that's changing.
2 weeks and counting.
I know. And then just some market recap of where we're at from last week. The markets are down a little bit. So we're down a little less than 1% right now on the Dow Jones, the NASDAQ, and the S&P 500, which are a few indexes. And the Russell 2000 is down a little over 1% for the year. So we did see with this, in the last week, with the short week, the markets are down a little bit year to date. Also, we're seeing mortgage rates. They've hit the lowest level since October of 2024. So we're slightly down from last week. Looks like mortgage rates for 30-year right now is 6.5%. And the average 15-year rate is 5.6. So that's come down slightly over the last week. And so we're still, like I said, still talking tariffs, taxes, and Fed cuts. And
you know what? I'd like to talk a little bit about the mortgage rates and what's going on in real estate, because it's not really being talked about a lot. But if you ask anybody who has a house on the market right now, they're probably reducing their price. Almost everywhere. I was just talking to a friend of mine who started off at $1.9 million. He's now down to 1.6.
Wow. That's a big change.
That's a huge change.
That's a huge reduction.
And that's over the past, I'm going to say, about 4 months, maybe 3 months. And that's going on all over the place. And so people who think that the Fed cuts are going to make a difference here, I don't think that they are. Because remember, though, the Fed is cutting the short end. But mortgage rates, I don't think are coming down. And if they are, it's just going to be a little bit. And it's a lot higher than it was a year ago when they cut rates by 0.5%. So for the residential homeowner, I think that we're in a position right now, or we're in a place right now where real estate values are coming down. Commercial real estate, some areas are stabilizing. The industrial part is stabilizing. Office space, there's still a lot of delinquency. I think that the vacancy rate is probably stabilized, but it's stabilized at a much lower point than where this was maybe a year or two ago. So the landlords are having trouble collecting enough money to pay their debt. So I think that there's some real issues with real estate. We actually have, I think, for the first time in a quarter of a century, the price of new homes that are being built is now less than the price of existing homes.
Interesting.
Okay, and that hasn't happened. It didn't even happen during the housing bust. Okay, so there's almost no way that I think that the price of real estate, especially residential homes, aren't coming down. And I think they're going to come down by a lot more.
I'm surprised that the building is that much less expensive with the tariffs and everything.
Well, what they're doing is they're giving tons of incentives to people to buy their houses. Because
I think they can buy the rates down easier from the builder standpoint, too. I read at one point.
Well, you can buy rates down, but it's still a cost.
Well, now I'm not talking about the buyer. I'm talking about the builder given incentives. They can finance that cheaper at a lower rate without the buyer buying it down.
Well, the fact remains, though, that those prices are less than existing homes, which means to me that the existing home sales, they've got to come down in price. And I'm seeing that. I'm seeing that almost across the board. I was looking at less expensive homes. In California, less expensive still means expensive. And that's also, by the way, part of the problem. We have across the country, but especially in places like California, probably New York and some other places, it's too expensive for people to actually be able to afford. So at some point, with everything else that's happening, prices just have to come down. So if you are in the market to buy a house, I might be a little patient here because I think you're going to get, this is obviously just an opinion, but I think you're going to get a better price in probably the next 3, 4, 5, 6 months. If you are selling a house and you have an offer, take it.
Take it now.
Well, it's interesting. We have a few clients right now that are moving out of state, out of California, and they're looking. And we have one in particular that she is being patient. I said, go look, just get an idea. I know it's hard when you walk on a lot or walk on a home, but I said, let's just be patient, go see, make sure you like the area. But she does have some time on her hands to make sure she can get a good rate and maybe a lower price.
Well, hopefully that's true. I mean, some of it is the same. In other words, if it's coming down here and it's coming down there, it's still the same. But for those people who own the house now or own their commercial properties or whatever, I think they've got an issue right now.
Yeah, one of the other areas that this kind of dovetails into cost of housing a little bit, which is electricity. A lot of the news talks about the Mag 7, the shiny stocks that everybody is buying, but there's other opportunities out there because all of those stocks might be a little richly valued at this point. But with utilities, electricity is growing at its fastest pace in over 40 years. And the side effect of that is, did I say demand? I did say demand, right?
No, but you can say it now.
There you go.
Electricity demand is growing at the fastest pace in 40 years, which is driving up the cost of electricity everywhere. So, and these data centers are the big culprit there. And to power all these AI models and everything that we all are hearing about every day besides tariffs and taxes and things like that. But, this AI is really a national security issue. So it's an economic imperative that, we really build these things out. But our infrastructure is antiquated. We haven't done anything to help move power, even if we can generate more. So I think there's a lot of different areas that we can, invest in that aren't, these shiny stocks that everybody is usually talking about. But just to give you an idea on the amount of electricity demand, how that's gone up, since 2010, it doubled by 2017, it doubled again in 21, and since then, it's doubled again. And it's predicted conservatively to double in the next 10 years. So, more than half of that demand is coming from these data centers. So, and what does that mean for prices? In June of 25, it's 7% higher than last year. And, it seems like it's going to be going up at probably about an 8% clip for the next 10 years. That's more than doubling your cost.
Yeah.
So what's the solution to that?
Well, we need to figure out, other areas, solar, storage, geothermal, nuclear.
I don't think solar and geothermal and that, they just don't have enough power.
You're right. And there's still a small window from what I understand with, solar. Part of the One Big Beautiful Act. One of the negatives is EVs and residential solar is going away. So if you want those, get them now. But wind, utility scale solar projects that begin construction before the middle of next year and are going to be completed by 2030 are still going to be subsidized. Tax credits are still out there for energy storage, batteries, geothermal, hydropower, and nuclear power. So,
I was reading an article about that as well.
yeah.
As I say, and you touched about all these on the solar and all the changes coming up. Some of them are coming up at the end of the month.
Yes. So if you want that electric vehicle credit, you have until the
that's-
end of September. September
wow.
30th is the last date that
Yeah.
you will be allowed to actually.
But the state of California has some bills coming through right now
They
that
do.
essentially would make it impossible for you to have anything but electric, whether it's electric stoves, electric cars, whatever.
I've heard that,
And we
yeah.
do not have the infrastructure for that.
Right.
And sometimes I wonder, who are these knuckleheads who can't see this right now, that are in power? And it's not just in California, but California probably leads the nation in stupidity.
Well, on that note,
So back to the One Big Beautiful Bill
Yes.
Act. We did record a webinar this last week.
we
on
didn't.
that.
We actually have it coming out on our newsletter if we haven't already. So make sure you check that out.
But I did read a really interesting article, and it was talking about bonus depreciation, and I kind of touched on that when in the webinar, but also on the podcast, I think. And I was talking about how bonus depreciation is basically you can write off the equipment that you purchase for your business. And I was thinking it strictly from a business perspective, but thinking of it from an investment perspective as well. This article was talking about how the reinstatement of 100% bonus depreciation by the One Big Beautiful Bill Act, it's accelerating investment across AI, infrastructure, and semiconductors in the U.S. because all of a sudden these companies can write off 100% of the cost of the equipment they're buying. So I thought that was really interesting to read that, and it says, and you touched on it, the key tax incentives for hydrogen and nuclear. So there are definitely some incentives that are still out there that are still available, but solar will be going away at 30% credit.
As far as the incentives are concerned.
Yeah,
Well,
correct.
for residential, I think
For
there
residential,
are still
correct.
opportunities for industrial size.
But the other thing that this article said that I thought was interesting is that while direct tax benefits of the One Big Beautiful Bill Act do favor those heavy asset sectors, that there are other beneficiaries of this. So the equipment suppliers actually also will benefit because people will be buying more assets. So I thought that was interesting.
Yeah, but we need all forms of the energy, but
Yeah.
there's so much demand right now.
Yeah.
At least in my mind, I think that nuclear is really the only viable solution for what we're going through. I mean, and the demand, as you said, on electricity is just going to keep getting bigger and bigger, and especially, again, if governments say that that's what you have to use,
Right.
as opposed to using natural gas or oil or who knows what.
Well, battery technology is getting better and less expensive. It's not probably where it needs to be yet, but being able to store it from wherever you can get it, usually like the renewables of solar and wind and wherever else, but geothermal, I guess. But that's going to help.
It's going to help, but
I think you need it all, like
I
you
think
said.
it's like
though.
a mosquito on an elephant.
And I always wonder, too, with the solar and all these things, in 10, 20, 30 years, what do you do with all these materials? And that's going to be a whole nother recycle. And
What have we done with all the batteries from all those
Batteries.
cars?
Right?
Yeah.
It's like, oh,
where
wait a
where do you
minute.
put all that stuff?
So,
Right? That's why we're going to the moon and beyond.
There you go. We're going to just put it in one of Elon's spaceships and shoot
you
it
go.
out there.
All right, yay for 100% bonus depreciation.
there you go.
So-
Yeah. That is interesting, though, how it kind
thought
of
so.
feeds the cycle a little bit, primes the pump. I like that.
So over the last couple of weeks, we've had a lot of financial planning and retirement planning meetings. We have some prospective clients we're talking to that are kind of forced into looking at their finances or looking at potential retirement early or potentially retiring, looking for a job and working and then retiring. We also have another client that wants to make sure she has enough to, she works till age 70 and has enough to live on. But it's interesting, the one thing that keeps coming up with these conversations and is the kind of lifestyle and the budget. And so it's interesting because these clients have a lot of money and they really don't have a good handle of
How much do I spend every month?
And it's like this block though. It's and not just these clients, but a lot of clients, they don't know where to begin or how to even like start this process. And so it's interesting. We've recently had to set up kind of another consultation just to help them kind of navigate that
I
a
went
little
to
bit.
coffee with one of the gals. By the end of the coffee, she brought 3 months of bank statements, 3 months of credit card statements. By the end of our meeting, she's like, "This was easy and
Yeah.
fun."
Yeah.
So,
You know what I also find out is there's a lot of people who don't understand the tax consequences.
Implications.
All of a sudden, they're no longer working and they're living on whatever it is, and they're saying the government is taking how much out of my money?
Yeah.
It's incredible how much you are paying in taxes.
Yeah.
When you start looking at if you have Social Security or if you have required minimum distributions or if you have other income sources, all of that adds up. And so, yes, you definitely have to pay attention to
I
it.
just saw a funny commercial like this morning, I think it was, about two people talking about retirement planning.
Mm-hmm.
And this one gal's talking, I'm working with my person and we're planning all this stuff. She goes, the other one's like, yeah, I'd like to think about that, like today or,
Mm-hmm.
this week or, this year. Yeah, that thinking's good.
Yes, good.
Because people, it's hard for them to wrap their head around what does that lifestyle look like. So
Well, it's interesting. Prior to this, Rachel and I just did a Savvy series where we tape different kind of podcast on different topics. And we just had a conversation today about financial self-care and maybe some action steps to take to help you get in that money mindset or looking at your finances. And so
having routines in place
Yeah.
so that you actually, on a daily basis, have a routine to better your finances.
yeah, and really this not, making money fun and enjoyable, not just
Not a punishment.
Stressful.
right?
Is this like financial yoga?
Yeah, well, that's what we said. He said everyone thinks of wellness. They think of yoga or
Facial, spa days.
yes.
going to the gym.
We're like, now we're going to throw in financials.
Financial wellness.
But
So I was going to tell you last week about the CNN Fear and Greed
oh yes,
Index.
Yes.
let's see where are we at.
And interestingly, we are almost right in the middle of neutral. We're at 51. So
Really?
that has taken a dramatic drop from the greed that we saw just a couple of weeks ago, really. We were at the 75 level. At one point, we were higher than that in about maybe a couple of months ago. But 51 tells me that people are nervous. People are cautious. We talked about real estate. I think people think that the stock market is way overvalued. Although you could make an argument that it's not cheap, but you could make an argument that it's not in any kind of a bubble territory,
Right.
because the amount of earnings that are coming in are still astronomical.
Right.
But nevertheless, prices are still expensive.
Yeah.
So 51, that's a big change.
Yeah, it is.
That's a good thing, I guess, from our
Well, if
perspective
people are being
that-
cautious, it is
Yeah.
a good thing.
Right.
That's
what I mean. They're just not having the FOMO and stuff. When,
And does it tie into? We also mentioned September is always a month that's there's not as much movement or it's down a little bit.
No, so actually, September is the only month of the year where I believe I read this, that we actually have lost more times than we've won, as far as the market is concerned. Interesting. So every other month, the market, and over time, the markets have always gone up. But September, for probably lots of reasons, I think one of the reasons too is that you get people coming back from summer vacations and they kind of get back into the market, see where it's been. But I think a bigger part is that the mutual funds believe
do.
that there
They
isn't their
start-
tax deadline at the end of September.
September 15th, maybe? Or, no, 30th.
September 30th. So they're probably selling off losers.
I think
yeah.
it's actually in October, but just
Tru-
like
no.
Trusts are due September 30th. So
But you're talking about taking the gain,
Yeah.
like the
Yeah, so the mutual funds, even if it's
Yeah.
October
but they're
15th.
trying to get ahead earlier now.
Exactly.
Yeah.
They keep trying to front run everybody else, so it gets earlier all the time.
September
Yeah.
15th, sneaky thing.
So it could be that has a lot to do with why September is kind of a bad month, because a lot of the mutual funds are getting rid of their losers.
Yeah.
Because they don't want to show people, we didn't have that stock, even though they had it for 11 and a half months. It's a fun game to play.
It is a game. Oh, boy.
So, all right. Anything else going on that we should know about? Other than my Padres seem to be
Are they
folding
winning?
here.
No,
they've
they were
lost
doing so
5
well
out of
for a little
their-
bit. What
Got
happened?
Swept by the Orioles.
Yeah, they've lost 5 out of their last 6, and I think they're dying on the vine.
2 out of 10 winners.
A lot of injuries, but that's another game. We'll talk about that later. In the meantime, we will see you guys next week. Have a great week.
Great. Thank
Thanks.
Bye.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.